Hello everyone, my name is Tianyu Yang and I'm from the University of Michigan's Ross Business School. I'm the associate of the Society of Actuaries. I've been trading stocks and options for years and I'm quite exposed to all kinds of option trading strategies since December of last year. And so since last year, since Christmas of last year, the Nasdaq index have climbed about 25%. And I'm recording this video on March the 22nd, which is a Friday. The index declined about 2.5% today, but previous to today, on Thursday, it climbed about 1.5%. So shown on this graph is a picture I took from yesterday. Is the Nasdaq 100 index is 7,493, and after the market closed today, it's about 7,300 something. Yeah, it's a pretty bad day, but I still believe that the market is a bullish market. So I would like to discuss about some option strategies that can be used in the bullish market, but you might not want to be so risky since you don't know what's gonna happen in the next day or next week or so. Okay. So we know options are good, but it is quite challenging. It's good and lucrative since you can be able to profit in all the bullish, bearish, and volatile market conditions. And you have many strategies designed, especially for each market condition. So for people who with less asset but with more willingness and time to invest, and especially for finance major students and for investment professionals, you can control lots of assets with small amount of money, which is good for you to get more sense about the market and get more training about get more training. And also options are highly risky. You might be able to gain about 500 1,000% on your call or put on a single day. But if you do it in the wrong direction, if you short sell a call or a put, you can have a devastating effect on your portfolio. And options trading is very technical. You must have a very quantitative mind in order to do well in this. You need to be familiar with all its risk. You need to be familiar with all the option Greeks. You need to be aware of the time decay and volatility, and you need to have a clear sense of what each trade you are going to do. And options are good since successful trading can make you look like you are a stock trading expert to others. Since if you post some successful trades, like you gained several $1,000s in a day, others might find you very very reliable or so. But maybe on the next day you will lose the same amount of money. And finally, I think doing some option trading trainings, you will get closer to your dream of being a portfolio manager in the future. Might be what I want to do in the future. So we know that even in a bullish market, I believe there are very few people that can consistently make profit by just buying some cheap, out of the money calls. Since if you are quite uncertain about the market, only buying out of the money cost is definitely not a reliable thing to do. You can, if you want to make steady profit, you want to count on this method to double or increase many times of your portfolio value. You cannot just count on this method, since if the market just downturns, or if the market is bounded to a range, how can you make profit by just buying some cheap out of money cost? So actually, I think you have a less than 1% probability to own the out of money cost that rises 1000% tomorrow. Since if you just check some stock, you see that, wow, it has about 20% volatility, but it has risen about 10% in the stock price. That's approximately a 1000% increase in some out of money call values. So, but this is very rare, and even you have purchased this stock you have purchased this call in the previous day, you might have already sold it much earlier, before it reaches this amount of increase, unless there are some big news coming toward the company, such as some examples I experienced include NVIDIA cuts its profit target in January 2019, and Boeing's fatal crashes, and also Facebook cuts its target in July 2018. These are some famous examples of some big decrease in the stock values. So what we want is more techniques and more higher expectations, but less of pure gambling. So our goals to look for a profitable trade in the bullish market is, we want to, since we are doing options, we want to do it in short term, since the market can change very quickly. If you're never sure about what's going to happen in the next month, since the Nasdaq index is already only about 300 400 points below its all-time high value. About 300 points. So you are not certain about the future outlook. So you want a profitability in every week, or you want it to be steady. And secondly, we want some the expected return to be greater than zero, since which means that with more than half of the probability, you will get a good amount of profit, and also you expect to have limited risk. You don't want the risk to be uncapped. So I'm not meaning that uncapped risk strategies is not good strategies, but you can have uncapped risk, but you must keep a stop loss to prevent your portfolio value from crashing. And also we want to profit from time decay, since we are doing it in very short term. Time decay is theta is very important for our trading. We have there are a lot of things about options that we are uncertain, but the only thing we are certain of is that through time, and as we go through time, the options are all decaying in value. So they're all decreasing in value. That's why we definitely want to profit from the time decay. it happens the fastest in the last week. Yeah, people say in it's fastest in the last month. A lot of people say that, but the last week is when you can really visualize the time decay. As long as even if the stock price stays bounded to a little range, you can see the option value just decay hour by hour or after every 15 minutes. You can see a clear downward slope of the option value. And also, we want to profit or remain unaffected from the decrease in volatility. Since volatility can be very important for our option trading, but definitely we are not trading using these strategies through major events such as earnings or others. So there might not be a very big difference in volatility, but uh, so, but we want to prevent this the decrease in volatility from happening. So that's why we wanted to remain unaffected or benefit from the decrease in volatility. Uh, Next point, I think we want to avoid the naked position. Since a naked position, a naked call, we need 100 underlying stocks to as a collateral, and as a naked put, we need 100 times the strike price as a collateral. It is not a small amount of money. If you want to trade a stock like Amazon or Google, you need to take about 170,000 dollars as a collateral. For I don't have so much money on my account since I use all my money to trade options. So I don't want a naked position since you are using about more than $100,000 to bet on a trade that can at most give you maybe 10,000, 1,000 or $1,500. Yeah, that's approximately the price of a as a money call or put for these two stocks. And we want to profit using relatively small amount of money in our portfolio. And also, psychologically, I think we want to have a strategy that we can avoid. Oh, and this case is on this case is based on a strong market, which means the market steady climbs, or suddenly climbs to a high value. We want to avoid closing the position too early and missing majority of the profit. Since in a bullish market, the market might not open at about a 2% increase or just 1% increase. It might open close to its previous close value, previous close price, but it always climbs steadily to its 2% or 3% increase. So if you are longing just a call option, you might easily get panic about